So in the long run, we think there's three things that really are key to thinking about the outlook for growth. That's how much labor you have, how much capital you're investing, and how productive you are. Those three things will drive our expectations for growth returns in the long run.
The individual and the citizens and the workers in the United States are different than they are here in Korea. What we found is that it's, as one of the kind of most mature retirement markets in the world, the United States is a great place to start.
Thank you very much for having us here today. My name is Kerry from JPMogan Asset Management. I'm going to spend the next 30 minutes talking about our long-term views for markets and for economies around the world. So this is a 10 to 15 year view. My colleague Jordan is going to speak more around our view for markets for the next 1 year when he speaks up. But if you have questions around anything, please do interrupt at any time and happy to answer them. So our long-term capital market assumptions, something we've been doing for 30 years now, something that has grown from forecasting asset class returns for 12 assets to now thinking about returns across 200 asset classes in 20 currencies. And it's something that's used internally. This is not an academic exercise. It's something that we do to feed into our own strategic asset allocation, and in fact across the asset and wealth management business, it underpins around about $1 trillion of investing around the world. So we very much do eat our own cooking when it comes to thinking about these numbers and how we use them as a starting point for building out that strategic asset allocation. It's very much a collaborative research project across the whole of JPMogan Asset and Wealth Management. There are some big themes in this year's LTCMA. Ones that we have talked about in the past, but ones we see as becoming more prominent and more important for thinking about investing over the coming decade. Now, those themes relate to things that we are very familiar with and that we've seen a lot of in markets over the last 12 months. And they are first off around the rise in economic nationalism. There's the idea that we're moving towards a more fragmented global economy. We now have trade and tariff barriers coming through. We're thinking about attitudes towards migration and the free movement of labor. And it's not just a US phenomenon. We're seeing that in markets around the world. On top of that, we have governments that are more willing to spend to try and smooth that journey for their populations, to think about how they can invest in more capital, how they have to invest for defense, thinking about energy security, or even simply moving towards greener economies. We have a lot more fiscal activism and a lot more fiscal support in governments coming through. Now, while this may be viewed as being good for economic growth, it obviously creates some inflationary concerns if that investment isn't for productive reasons. And similarly, with the movement towards a more nationalism around the world, it's more inefficient in terms of thinking about economic growth and also creating those inflation upsides that we could see come through over the coming decade. However, against that, we have another powerful force which we see as being a key trend over the coming decade, and that is around AI and tech adoption. If we have these headwinds from thinking around policy changes on nationalism and trade or the fiscal element, we have this tailwind that comes through in terms of increased productivity from AI and enhancement of economies over time. And importantly, a lot of that benefit does feed back into thinking about corporate performance, whether it's around protecting profit margins or increasing efficiency, whether it's in private equity and how you enhance the value of companies that you're buying. It's going to be something that's going to hit all asset classes in terms of being a little bit more of a positive for the outlook we think over the coming decade. So these big headwinds do have a bit of a silver lining when we think about the outlook for the next decade in terms of our return profiles. The upshot of all that is thinking about these market trends that relate to those themes. Now, the first I kind of mentioned when it comes to AI and building on what they actually are, and that's around that broadening out of the earnings expectation and the returns on equities. Obviously, we think about how artificial intelligence and the benefit has accrued to a handful of companies around the world over the last few years, But more as we see that adoption build out, it's going to benefit more sectors, the users of that technology, and more countries around the world. So we think about that broadening out of the earnings growth globally in the equity market. We also think about what's happening when it comes to the outlook for fixed income. Now, fixed income is not very sexy. People don't really like talking about it. Yields are okay, but you know, when you're getting 70% returns out of Korean equities, thinking about 5% or so returns from bonds isn't terribly exciting. However, we're at a point where we actually have decent yields on fixed income, and there are these downside risks to growth. And so we do think about the returns in fixed income being more important, but really being a bedrock in a portfolio, given our return forecasts are very much some of the strongest we've seen since 2008, because we're not coming from a very low base on yields, we're coming from a relatively high starting point. And then finally, the other big theme, and something we've talked around the LTCMA for a number of years, has been the fact that the US dollar looks overvalued relative to the fundamentals of the US economy. Now this year we've had a big depreciation earlier in the year in the US dollar around those trade and tariff concerns, but it's also created somewhat of a trigger in reinforcing our conviction of seeing the US dollar continuing to depreciate over the course of the next decade. Won't necessarily happen in a straight line, but we do believe that those concerns around nationalism, those concerns around the fiscal and the deficit size in the US, all weigh on the outlook for the US dollar. And so thinking about hedging your exposure becomes more important in that environment for thinking about global asset classes. So what does this all mean in terms of a portfolio? Well, it does mean that we think about broader diversification in our portfolios, we think about fixed income in that portfolio, but it also means we need to have other assets that hedge off some of that inflation risk, and that really does lean in towards the world of alternatives a little bit more. And so when we think about our 60-40 portfolio, stocks and bonds, it returns 6.4% annualized over the coming decade. But if we add in 30% of alternatives to that portfolio, suddenly we're getting a number that's 6.9% and has a much better Sharpe ratio, a much better risk-adjusted return that's actually 25% better. So that alternatives is becoming a much broader point for many investors when they think about how to mitigate some of the risks and challenges in the year ahead, and how to take advantage of some of these secular themes such as AI. They're going to be very present across things like infrastructure, real estate with data centers, or even thinking about how transport may be impacted by shifting trade routes and tariffs overall. In terms of the numbers, this is just a summary slide. The numbers shown here are for US dollar returns. We have Korean dollar returns or Korean won returns elsewhere in the presentation, but these show you our expectation for annualized average returns over our 10 to 15 year time frame. Now, something that may be surprising, even with the really strong rally we've had in US equities for the last few years, is that we still expect US large cap stocks to return 6.7%. Now, there is that drag from higher valuations that we have as a starting point, but also a realization that a lot of these companies in the US are very profitable and are very good at keeping those profits growing, and that their valuations in the future are likely to be higher than they have been on average in the past. And so it does mean we still see good returns from US equities. Looking around the world, you can see for EFA, this is just the rest of the developed world or emerging markets, you are getting pretty similar returns to last year. A lot of the difference between this year's numbers and last year's numbers are due to that currency movement for a US dollar investor, but that's going to be a different experience when we think about if you're based in the Korean won or not. On the fixed income side of things, we tend to focus on not just the comparison to last year, but the comparison to where we've been in the past. And so you see this light shaded 1.5%. That was our expected return for US Treasuries 5 years ago. That was a period where we had lots of negativity about where we were going with inflation. We had very low rates. We had fiscal financial repression. We were thinking about quantitative easing. And suddenly we're at a point where You've had central banks move away from quantitative easing. You've had interest rates that move higher. You've had inflation that comes back up. And so you're getting back to a point that feels a little bit more normal when it comes to the outlook for fixed income. And those highest yields as a starting point largely lead us to have a much stronger return outlook in the coming 10 to 15 year period than we did 5 years ago. That's 300 basis points higher. So suddenly fixed income looks more attractive than it has been for many years. And again, it offers that diversification benefit against those growth risks because those yields can fall from today's level, where in the past they could only really rise. So a 60-40, still looking pretty good. Those returns are very steady on the equity side, improving on the bond side, and across the alternative landscape, things are steady to a little bit higher. So we see a lot of benefit coming through on alternatives around diversification benefits from hedge funds or real assets, or thinking about the outlook for private equity, given that it's much more in tune with some of the tech development we see around the world. Thinking about the economic outlook, there's a saying that goes, as much things change, they stay the same. That's very much true, thinking of how we believe the economies evolve over time. A lot of the headline growth and inflation numbers we have this year aren't that different to last year. But what has changed is the composition of that growth and what drives it. So in the long run, we think there's three things that really are key to thinking about the outlook for growth. That's how much labor you have, how much capital you're investing, and how productive you are. Those three things will drive our expectations for growth returns in the long run. And you can see here we've compared our 2026 numbers with what we thought about in 2021, and there's a bit of a pickup. So if I pick on the US, for example, you can see that the growth number is a little bit higher, and then when we add in that blue box of inflation, the nominal growth rate is a lot higher. But the breakdown is this little blue box here at the bottom, the one that says 0.4. 5 years ago, we thought that the supply of labor was going to add to the outlook for growth. Since then, we've had lots of changes around net migration, policy changes, a demographic profile around aging that's still quite bad, and suddenly we don't think it adds to growth at all. There is no supply of labor that's going to increase the outlook for growth in the US over the coming decade. What happens when you run out of workers? You become more productive. Productivity is the answer to not having enough workers. And so when we think about the productivity uplift, which is the green box, you can see it's gone from 0.7 to 1. We can see that that yellow box about capital investment has got bigger as well. So those themes around nationalism and fiscal feed back into thinking about how we think about growth, because governments are going to invest more and companies have to become more productive to drive that growth forward when there's not enough labour. And that's true across other markets. You can see there's no contribution from labour in Europe. There's a declining contribution in Japan because of the worsening demographic profile. And the same is true in China as well. It's all about that uplift in capital investment and productivity that is going to drive the outlook for growth. And if anything, we're probably a little bit conservative. That AI boom could be much stronger than we assume, and these numbers could be a lot higher. So there's upside risk to the outlook for growth in the long run for us. You also see those little blue boxes, that top one, the dark one, that's our inflation forecast. You can see those numbers, 2.5, 2, 1.7, they're not excessive. We see inflation being a little bit higher in the future around the world, but manageable in central bank terms. This does mean we think about higher cash rates than we did last year, but those interest rates are probably lower than where they are today. So there is a benefit from thinking about the fall in the cash rates. Even in the long run, we think about central banks having to cash rates a little bit higher to offset that little bit more inflation that's out there. So that's the growth story. Really good nominal growth rates still around the world. That's important because that drives our outlook for equity earnings in the long run. That's how we see corporate revenues growing over time, by thinking about how we translate revenue growth from economic activity and economic growth. So when it comes to the outlook for equities, for fixed income, I'll come to equities in a minute, I started with that outlook piece around cash rates, those higher cash rates coming through, and those higher yields as a starting point from where we were in the past. And again, comparing today back to 2021, there is a meaningful difference when it comes to the outlook for fixed income. This faint green portion at the bottom, that's what we call normalization. That's the drag from yields having to go from a low level to a high level, which erodes your return because yields and prices move inversely. That was coming from a point of those very low yields back in 2021. Today, yields are much higher. I look at the yield on a US 10-year Treasury today, it's around about 4.1%. In the long run, we think the yield on US Treasuries is about 4.1%. So there is no drag coming from that normalization. There's nothing holding you back in terms of the expectation of yields having to rise. On top of that, that blue bar, that cash rate, you can see is higher than it was 5 years ago. And so you get this quite stronger return from the 10-year portion of the market. We also think that those concerns around fiscal spending, inflation uncertainty, and that central bank movement away from quantitative easing means that there's fewer price insensitive buyers in the market. That steepens the yield curve. That's that term premium that gets built in. And again, that's something we saw back in 2008 as we return to that more normal environment and we see that steeper curve come through around the world. All that builds on that return that you get from fixed income. In credit markets, not too much has changed. We see a quality improvement across public credit markets. We think about high yield, where a lot of that quality has moved up because a lot of the riskier parts of that lending went into leveraged loans or private credit, seen some of the distress this year in that asset class. And so we don't think about a big rise in defaults. Obviously, we're starting from a point where credit spreads are very tight, and so we do expect them to widen. That leads to that drag on normalization, so yields have to get wider on average over time. But that improvement in credit quality means that they don't go back to those very high average levels and maybe a little bit tighter than many people assume. And so you still get a very good return out of public credit markets overall. So that's our long-term view on fixed income, that it is now an asset class which provides return, which provides income, and again has a role in a portfolio. Linked to that is obviously the currency outlook. And if I could go, back this one. If we think about where cash rates are going and inflation, that influences our outlook for currencies. And we also think about valuation. So where currencies are today relative to where we think they will be in the long run. So the way we measure currencies is by both looking at the difference in inflation across different markets and then that valuation, how we think about where fair value is in the future for a currency relative to today. And we do that by using our expectations around inflation forecasted. Typically, if you have higher inflation, your currency should depreciate by more than a currency with low inflation. You can see a couple of things that really stand out when it comes to currencies, and that is the fact that a lot of the movement we've seen has been against the big developed market currencies like the euro or the Swiss franc. So last year, we thought about the European Union and the euro having a 1.2% depreciation every year versus the US dollar. But because you've had that big movement this year, when we forecast forward 10 years, we think that difference is only 60 basis points. A lot of that movement versus those big currencies has happened in our view. So where is that 10% depreciation that I mentioned in the US dollar coming from? It's coming from the Asian currencies. It's coming from the Korean won, it's coming from the Chinese yuan, and also it is coming from the Japanese yen. So we expect a lot more of that currency movement to happen against emerging market currencies relative to thinking about what it means in the developed world. Currencies where countries have larger current account surpluses, or where central banks may be hesitant to get policy rates back to neutral because they want to keep their currencies either weak or elevated against that. So that currency movement being so large does mean there's implications for thinking about hedging, particularly as I show you on the equity slide, how that can influence the return when we think about the return in Korean won versus the return in the US dollar. For equities, the question we've had commonly from clients when presenting this material has been around how do you still get a really good return from US equities when they've had such strong returns and the valuations are high. And we would agree the valuations have moved up a lot. When we look at valuations, and here we're saying trailing price to earnings ratio, you can see at the end of September, when we published this data, the US equity market had a valuation close to 25 times on a forward PE, on a trailing PE basis. Our expectation, though, is that that valuation should be around about 20 times, so that dot at the end. So it's going to come down. It's going to be lower. That's going to drag on our returns. But the average historical trailing PE is about 16. So our assessment that those companies within that index are actually worth more. They're better at producing profits, they're higher quality, and so they justify that rise in valuation. So we don't assume that you're returning to average when it comes to these valuations. We think about the movement higher in those valuations over time, and that mitigates some of that drag. The same is true in margins when we look at it that way. For the rest of the world, you can see the movement is not nearly as great, that actually these markets are closer to how we would think about fair value over time. And so again, that does mean there is a benefit to thinking about a diversified equity portfolio rather than just thinking about the US overall. It's really reflected in that fact about that broadening out of the earnings story I mentioned when it comes to tech adoption, that the US has been quite exceptional in terms of the earnings growth driven by those Mag 7. If we look at the earnings outlook, this is the last 15 years annualized number in yellow, and the blue is our forecasted earnings growth over time for 10 years, not for next year, for 10 years. And you can see the rest of the world is catching up, whether it's emerging markets, whether it's other developed markets, or thinking about the broader equity index. So this is actually a positive for thinking about the return outlook for markets outside the US. And this is how we break it down. So this is the US market for US large cap. You can see our return at the top, 6.7%. Korean won, it's 4.7% because we have 2% depreciation. If you hedge out that risk on currency based on our cash rate assumptions, that movement is only 110 basis points, so you get a bit of a gain from hedging that. But you can see compared to other markets around the world, Japan, you get 6.8%, much better than the US. In the Euro area, you're getting a little bit above 5.8%. You're thinking about the emerging markets more broadly, 5.8%. So there's a strong case for thinking around the rest of the world, not just the US, when it comes to looking for global equity exposure. But you can still see the US has a very strong revenue and earnings growth number here, given that 6%, given that stronger nominal growth story, and that drag that comes through from the valuations is very present. It's that green portion, but it's not the only thing that's going to be a negative in terms of the outlook, and it can actually become a positive if we do see that valuation assumption move higher in the future given the quality of those companies. So I think there's very much an opportunity for global equity exposure based on this and thinking about how it does come through. And then on the flip side, in the emerging world, we assume that companies are less efficient, that they go to the market to increase capital a lot. They do a lot of dilution in terms of the issuance of shares that comes through, and that's that yellow box. That's the issuance of shares which drags down the outlook. However, as we've seen, Korea has a value up program, China's pursuing something like that, Japan is moving down that path as well. These countries and companies are moving to increase the value of the shareholders of their companies. They're coming towards becoming much more efficient on the return on invested capital. They're thinking about how they increase their price to book, if you want to put it that way, for Japan. That actually this drag from issuance and dilution could actually become smaller in the future as these companies become more capital efficient and actually start to look a bit more like developed markets in terms of what that yellow box does. And so again, it does offer some upside to thinking about the role of emerging markets in a portfolio as well as thinking simply about developed markets. So in sum, the US still looks very good. We don't believe it's the end of US exceptionalism, but the US is less exceptional than it once was. There's still a strong case for thinking about US equities, given the return profile, and given the fact that they do present companies that are very much at the leading edge of a lot of what we're seeing in AI development, and so that makes them very profitable. But those valuations create a drag relative to what we see in the rest of the world, and so that global diversification, as we see that earnings growth broadening out, is quite critical for thinking about long-term investing across our forecast horizon over the next decade. And then finally, I want to talk about alternatives. Going to go forward one page. Alternatives are becoming more and more key in many clients' portfolios because they're looking for broader ways to diversify some of those risks. They're worried about the concentration that comes through in public equities. They're thinking about the inflation shocks that could be out there, and thinking back to 2022 when both stocks and bonds fell and the correlation between stocks and bonds rose significantly. Or they're simply thinking about the valuations in public markets and moving towards private markets for something that's better valued in terms of what it can deliver for return. So all those forces are driving a more critical role for alternatives in a portfolio to add that alpha, to add that income, to add that diversification benefit over time. And I think you're also seeing a response in asset managers to deliver products that can do so in a more liquid format. The real key thing is the inflation outlook. So when we think about the return for inflation, it does higher overall, so a little bit more higher inflation in our numbers coming through, but it's the volatility in that inflation which is important. Historically, there's been different regimes in inflation and that correlation between stocks and bonds. So if we look at this chart here, it's a correlation between US equities and US treasuries, and you can see that there was periods where that correlation was very high. That blue line on average is very high. That was when inflation was relatively high, back in the 70s, back in the 80s, high oil prices, and that correlation was not nearly as negative. But a lot of us are used to this experience through the 2000s when that correlation was negative. You had inflation that was at or below target, you had that benefit of owning risk and being able to hedge it off by owning fixed income, and it worked really well. And then COVID hit and we had 2022, massive supply shock, inflation spikes, and suddenly that correlation surges. That's what people are fearful of about repeating. And we do think over time you're going to have more episodes of that higher inflation. It's not going to be persistent, but you'll get more spikes in inflation, and that volatility inflation is something that's very key to try and mitigate in a portfolio. And so you can see our average correlation is a little bit higher. It still provides a correlation benefit to a portfolio, just not as strong as it once was. And so that's again how we think about alternatives, offsetting that in a portfolio. So when we do the LTCMAs, the final thing we put together is this frontier of asset classes, their returns, their volatility profile, and the 60-40. So this shows you the volatility and the return of various asset classes, and this is in US dollars, and our 60-40 portfolio, which sits across this frontier of just owning stocks and bonds. Everything that's up and above that line is a way to increase returns or potentially add diversification through volatility reducing measures. But we also want to focus on what happens if you add those private investments or private market alternatives into a portfolio and build up to something that would mitigate some of those risks that we see coming through. And that's this chart. It's just a blow up of what we have there. But you can see as you add maybe 10% alternatives, suddenly your return is higher and your volatility is lower. You add 20% and you go further up and to the left. You add 30%, which is similar to what a pension fund or a financial institution may do. You get closer to 30% and you're getting a much higher return, that's 6.9%, for a much lower volatility. So that's going to be a different mix depending on what your objectives are and your tolerance of risk and liquidity are. But it does reinforce the role of increased returns and lower volatilities in what alts play in a portfolio, given some of those inflation risks that come through overall. When it comes to just a few takeaways from the LTCMAs this year, I think it's very key to think about where we are in terms of the numbers still being very robust in terms of what we think coming through, even with the strong returns we've seen over the last year. Those valuations do create a drag when it comes to the outlook for the US, given the big movement, but our assumption that those valuations can be higher than we assumed, and those valuations don't go back to average, does mean that there is a good chance of looking at the US equity market still in a favourable light. But as you'll notice, the returns across the world can sometimes be better, and within that movement in currency and thinking about hedging it may be more critical for those returns overall. Elsewhere, we do see a role of fixed income in a portfolio, given those higher returns, those higher yields. It does provide income, it does provide risk mitigation to those growth shocks that come through, but not to inflation shocks. So we think more around the role of alternatives to really feed into that. Those themes around nationalism, fiscal expansion, AI adoption, they're very much long-running themes that we've been seeing really come to fore this year, but are going to be persistent with us. And so it's knowing how to invest around those for the future in terms of what we think in terms of our LTCMA outlook. So 30 years of the LTCMA, it's something we've done for obviously internal purposes, something we've now given to our clients because they've been asking for it and want to share how we think about capital markets, and something that we value in terms of what it does in terms of returns. This just shows you how our expectations compare to the market experience. Because we've been doing it for 30 years, we can actually compare 15 years of data with our 15 years of returns. So if we start in 2015, everything by this side of the chart actually compares what we forecast would happen relative to what did happen. So the blue bars are our average return from our LTCMAs in those years. The yellow bars are the actual market experience. And you can see most of the time it's pretty close. In fact, 75% of the time we're within half a standard deviation of those numbers. Certainly there's outliers like the GFC in 2008, but we do find these numbers are actually very robust and have been, not too distant from what the experience actually was. So we do find them quite reliable over time. So I'll wrap it up there in terms of our long-term views. I'm going the wrong way. And I'll hand it over to Jordan to talk more around the short-term outlook as well as the target date funds.
안녕하세요. Hello everyone. Thank you for having us. It's a pleasure to be here. I always enjoy coming to Seoul. For the next 30 minutes, I'm going to talk to you now. Kerry just spoke to you about our long-term 10 to 15-year assumptions. What I will do now is talk to you about our one-year outlook, how we're seeing markets in 2026, and then I'll also talk a bit about the target date funds that we manage in the US, just to show the partnership that we have here with Hanwha, how strong it is, and the depth of research that's coming out of the US that supports that program. So some main takeaways for 2026 regarding our outlook. We see next year being two halves. For the first half, we think there will be robust growth, which will be supported by fiscal stimulus. Trump's One Big Beautiful Bill will provide tax benefits to citizens in the United States, which we anticipate them spending, and that will help. As well, we think that the capital expenditure, companies spending for artificial intelligence, will also support economic growth. We predict that in the second half of the year, things may slow down a little bit as unemployment becomes more of a concern, and companies looking to increase or protect their profit margins and save for growth potentially maybe hire less workers or even fire workers. In terms of where we are with interest rates, last night the Federal Reserve cut the policy rate by 25 basis points. We think they will cut 1 to 2 more times next year. And so we will continue, in the US at least, to be in an environment where monetary policy is more easy. We also think that in other economies, we might see some rate cuts, potentially one cut here in Korea by the BOK. But there is concern, as we understand it, that that could spur housing inflation, and so there might not be a cut. In addition, we think that other economies maybe are toward the end of their cutting cycle. So there is some divergence in policy across different central banks. We think that there will be geographic dispersion, and so while the US is growing, it might slow down. We see support for growth coming out of Europe due to fiscal spending. China has its own structural headwinds, but the markets are doing decent and companies are growing earnings. So where over the last few years, especially in 2024 and 2023, the story was much about US exceptionalism. As we saw in 2025, Korea's market has performed so well. We think that we will see a broadening out and we can have strong performance in other economies outside of the US. As I said, China has its own structural issues, part of it being property, deflationary pressures, weak domestic demand. But we think that the policymakers can step in and support this and support activity. We do not anticipate that Chinese policymakers will issue very large and great levels of stimulus in one time. It will be more slow, but that they will look to continually support economic activity in a sustained way. There are risks to our view. The main risks, we think, are here at the bottom of the page, that consumers in the US might not be as positive and spend the money that they get from tax savings in the first half of the year, and maybe rather than spend it, they save it, and so it doesn't support consumption as much. Potential for a pullback in AI spending if companies do not see impacts to the revenues and earnings that they expect, but we think that's a low chance. As well as potentially more geopolitical risk. That's something we're mindful of. So these are the ways that we're looking kind of at 2026 at a high level. If I walk the next few slides, I'll walk you through a bit of the macro data that we're looking at and some of the trends that we're seeing, and then related to how we're positioned in portfolios at the end. So our global growth forecasts, you can see here on this chart, are that the US should grow GDP around a little bit less than 2% coming into 2026. Whereas the Eurozone, closer to 1%, while it will come down in the beginning, towards the end of this year, we think it inverts back up. And Japan as well, easing towards 1% and then kind of tailing back up. So the idea here is that we do think there will be a re-acceleration of growth as we get through 2026. And when economies are growing in the macro level, that's generally healthy for companies and corporates and equity markets. Emerging markets, we see the growth has was relatively high coming into 2025, and that growth is stable. China's GDP, we expect them to try to target between 4.5% and 5%. India has a much higher level of GDP, but we see that moving sideways. And so overall, the environment looks relatively healthy for economic growth throughout the world. We also think about policy rates. And so as we just saw yesterday, the federal bank cut. We have been in a cutting cycle across the UK, US, Eurozone, BOK. They've all been, Korea, they've all been cutting to some degree. The outlier is Japan, which has been hiking rates. We expect this to continue, as I said, into 2026 with the idea that there will be an easy monetary environment. One interesting point that came out of the FOMC meeting yesterday, Federal Chairman Powell mentioned that he sees no expectation of a rate hike, which was important for investors who were concerned that inflation might lead central banks to start hiking. Which would make policy measures more tight and actually hurt economic growth. So we do believe we're in an easy, accommodative policy world. That's important because fiscal deficits are relatively high across the world. And so the amount of government debt relative to GDP, you can see from where we were in 2010, the United States was below 100% of GDP, has moved up to nearly 125%, and expected to surpass 130% as we get into 2026. So there's more debt. These countries are taking on more debt. Same with UK, same with Eurozone. The outlier here is Germany. Germany here has much lower level of debt to GDP, and so they have more headroom to have fiscal stimulus and to spend, which is why we think Germany and Europe as a whole is an interesting market looking into 2026. For economies like Japan and the United States that have high debt to GDP levels, they need to be more thoughtful about the fiscal activity that they do, as well as the level of interest rates, because that determines their interest payments. And so if interest rates are higher, they have to spend more on servicing their debt. So they're, to some degree, thoughtful about that when thinking about issuing more debt and assessing policy rates. The labor market, particularly in the US, is very important to us, and it's something that we watch regularly because the idea here is that if unemployment increases, there are less workers and there's less people who have the ability and the willingness to spend. And so we watch unemployment very closely to assess the health of economies. And what we're seeing here is that the non-farm payroll, so how many jobs are being created, is actually is coming down quite a lot. As of the reading on August 2025, or 2025, there was 22,000 jobs that were created. Where we are today, given the fact that the labor market, because of immigration policies, the actual share of labor is coming down, or the amount of people in the labor market are coming down, that the break-even rate between how many jobs need to be created and how many people are entering the workforce to keep unemployment neutral is around 20,000. So it's much lower than it used to be, but actually this number feels low, but it seems to be around break-even. So we think that the labor market is healthy right now. But what we're watching and concerned about is this blue line, which is a bit hard to see, but unemployment rate in 2022 bottomed at around 3.5% for the US. Since then, it's grown, it's increased up to around 4.3, where the reading as of August was 4.3. Generally, in the past, we've seen that if unemployment rate is slowly increasing, there's momentum there. There's the potential that the unemployment rate can increase more. And so that is something that we look at as a risk and watch closely. At the moment, we think unemployment rate is healthy and that it shouldn't be an issue, but it's something we're watching. And then here we have, as I spoke about before, monetary policy, particularly for the United States. I thought it's important to just give some more details here because we just got this news yesterday of the FOMC meeting. And so, as I said, Chairman Powell announced that the Federal Reserve will cut rates by 25 basis points. There was some dispersion. Some of the members wanted no cuts. 9 members supported the cuts. 2 members wanted a hold. And then Steve Moran wanted a 50 basis point cut. So there is some, there's differing opinions within those who make this, who vote on the overall decision. But what Powell said to kind of calm nerves of the market participants is that all the members agree that inflation is too high. And they also all agree that the labor markets have softened. And so what central bank is focused on right now is trying to figure out how to balance unemployment that could potentially get higher, soft labor markets, and inflation that's higher than they wanted. And so while they want to ease to help the labor market, they don't want to ease too much that they create more inflationary forces and create inflation that they can't control. And so this is something that we're watching, that central banks are watching, investors are watching, to understand the dynamic between inflation and the labor market. I spoke a lot about the US. I'll say a word or two about China. China, we do think from a macro perspective, is making some changes to their policy, which is positive. Obviously, we've seen in the news a lot about anti-involution, this idea that they're trying to stop oversupply or overcapacity, so and basically limit the amount of price competition that's happening so that corporations can make a decent level of profit and basically not have a race to the bottom where each company is out competing the other and bringing prices down to an unsustainable level. That is happening to some degree, but we don't think it's going to be a massive change that's going to completely alter the dynamics of Chinese production, and that there will still be a lot of Chinese production that's flowing out overseas and creating deflation in other countries to some degree. Capacity utilization is part of this anti-evolution aspect. The fact here is that there is a lot of capacity in different parts of the economy, whether it be in cross-industry machinery, textiles, autos, chemicals. There's a huge amount of capacity, and then the amount of actual utilization are these green diamonds. And what you can see here is that actually they're not utilizing as much of their capacity. So there's this oversupply, which is creating this deflationary impulse in China. And so China's trying to deal with that. If they are able to deal with that, that's going to support earnings growth for companies because they're not basically competing for price. There's not an oversupply. It's taking supply down, demand stays the same, that should help the price. So we're watching that closely because that could be a tailwind, that could be a support for the Chinese economy if they're able to execute that. That being said, their companies in the equity market are growing their earnings, and we expect that earnings growth in China for large cap stocks will be similar or even above earnings growth in the United States. So we think it's an attractive equity market, but we also need to watch the macroeconomy to understand its flow through to that marketplace. So then, what I just laid out here was some of the macro views. As a portfolio manager, I'm a portfolio manager for multi-asset portfolios, so investing in stocks and bonds and alternatives, and my team across the world, we discuss on a daily basis how we should position the portfolios. And then we have these conversations with Hanwha and the target date funds to think about how to execute different types of trades or views. How do we take all the material I just spoke about and condense it into views? We have it here on this page. And so, as I said before, there's growth. The growth isn't accelerating in an extremely exciting way, but it's either stable or the idea that they will accelerate a bit towards the end of the year. There's no recession that we are concerned about. There's no concern that market activity will just stop abruptly and credit will stop flowing through the system. So we're overweight equities. Moderately, because we do acknowledge that valuations are high. It is an expensive market, but there's still a support from the fundamental economic space. And so we're okay to be overweight equities moderately. We try to spread our risk and take some of the risk, not just simply being overweight equities versus, let's say, bonds and cash, but also having relative value trades. And so while we acknowledge that the US as a whole is expensive, particularly the hyperscalers and the major technology names in the market, there is value in other parts of the economy, which we think will have opportunities to perform well in 2026. One theme we think about is broadening out. So other sectors besides information technology and communication services, sectors like utilities have performed very well in 2025, which support artificial intelligence growth by providing infrastructure and power for them. Healthcare is a sector that's very cheap. Does AI broaden out to that space to help companies become more efficient? US has benefited, but Europe, banks in Europe might be able to benefit from productivity gains through artificial intelligence. So we're looking at other markets. Japan, Korea have strong corporate governance reforms, are growing earnings, are delivering returns back to investors via buybacks and via dividends. So these are all supportive for the idea that it's not just about the US, particularly in 2026, but there's opportunities in other regions and other sectors. When it comes to treasury rates and duration as a whole, we're somewhat neutral in our duration positioning right now. We look at the 10-year as an indicator for where we think overall rates will go across the spectrum of different fixed income assets and instruments. Our view is that there'll be a range between 375 and 450 for the US 10-year. Where we are today is closer to around 4.15 or 4.1, somewhere in that range. And so if we see the 10-year increase because there's concerns about higher inflation or there's more term premia being priced in, investors need more compensation to invest in US government issued bonds because they're concerned about risks of federal independence or Trump, then we can see that going up. If there's a growth scare and investors are concerned about markets actually entering into recession, there'll be more demand for bonds, which would bring interest rates down. And so if we reach either end of these ranges, we would try to make a tactical position potentially. So if we see we're at 450, it might be time for us to buy duration a little bit because we think that's the higher end of the range. If we're getting down to 375 and we don't see actually a recession on the horizon, it'd be a chance for us to be short duration. And then overall credit, we are positive on credit. We think that the fundamentals of companies are still strong, balance sheets are still strong, companies are generating cash, free cash flow yields are healthy, and so that cash can ensure that these companies can pay their debts and pay their interest expenses. And so although part of what helps credit and extended credit returns is when the spread between the credit and a base return compresses, although we think that spread is very narrow, so there won't be that much benefit from spread tightening. Overall, all-in yields, so the baseline yield plus the extra compensation for the risk is still healthy, and so it's without a serious risk of default, which we do not think is on the horizon. It makes sense for us to also have credit. So at a high level, we're overweight. We're pro-risk in our portfolios. We're slightly overweight equities. We're looking for relative value between the different regions and broadening out across sectors, and we're also taking exposure from, let's say, core bonds and moving into extended credit. So that's a bit about our outlook. What I'd like to do for the last 5 to 10 minutes is just kind of talk to you regarding our target date funds. So I know in the beginning we spoke a bit about the Hanwha target date funds, and there was a reference to the smart retirement funds and the performance there. And I just wanted to share with the room a bit more context and detail about the partnership that we have between JPMorgan and Hanwha, and how the target date fund management that is happening here with Hanwha and in partnership with JPMorgan is supported and informed by a very, very substantial and massive target date fund operation in the United States. So there is in the United States a suite of target date funds that are called the Smart Retirement Funds that have been around for 25 plus years. The AUM managed for those funds is over 150 billion US dollars, and it's one of the strongest brands and established target date funds in the marketplace in the United States. When I first started my career at JPMorgan, I was working on this smart retirement team. I've since then moved to London for a few years. I now live in Hong Kong. I've lived in Hong Kong for over 7 years, and I've worked throughout that time with Hanwha and brought the insights and the information from the smart retirement operations and team over here to Hong Kong to make sure there's connectivity to Korea to ensure that what is happening with our partnership here with Hanwha is incorporating the thinking and the ideas and the thoughts that are taking place in the United States. So I thought it would be helpful to share some of how the smart retirement target date funds look at the world and what they're doing. So similar to the to the objective of the target date funds here with Hanwha, the overall goal for the smart retirement funds in the U.S. is to think about the participant's retirement journey. How do they get to retirement in a way that's respectable and expected and they're pleased with? And so we think about the finish line. We want to try to get as many people across that finish line as possible. How we do that is through 3 different kind of frameworks. We think about 3 different aspects. One, there's the overall glide path, which incorporates behavior of retiree investors or participants, retirement participants, which we'll speak about in a slide or 2. And through that behavior, we determine where we should start the glide path, what level of equities, how we should have an exposure to those equities, and where we should end the glide path. Then there is an aspect of manager selection, which I think was discussed earlier. With here in Hanwha, there is a very thoughtful approach to having active and passive kind of managers within the target date funds. Same in the U.S. Manager selection is an entirely point of focus to decide exactly what managers make sense, maybe at the beginning of the glide path versus the end of the glide path, and over time as market dynamics change, how we want to think about those, changing those managers potentially. And then active asset allocation. So similar to what I just spoke about, our views over the next year, we then tactically position towards those. How do we get those tactical positions into these overall target date funds and glide paths in a way that makes sense with the overall objective of the retiree participants? And then, as we're doing that, as we design the glide path, what are the basic kind of things that we're thinking about, considerations? So it is the participant behavior research. It's thinking about the individuals in each market that are going to retire at some point. How much money are they contributing to their retirement plan on an annual basis? What is their starting salary? What type of support are they getting from Social Security or the national pension system that's already going to help them get to that retirement goal? And so then how much more does the target date fund need to help support to overall help the individual get to that finish line? So we think about this from a holistic standpoint. We're thinking about all of the inputs for the retirees and then designing the glide path around that. We also think about regulation and legislation. So as I understand it, there's a change starting at the beginning of this year in Korea for the National Pension Service, where the required amount of contributions will increase from 9% by 50 basis points every year until it reaches 13% in 2033. That's a regulatory change that's going to change the dynamic of how retirees potentially can save. They're being basically pushed to save more from that National Pension Service. So what does that mean for our glide path design? Do we need to be as aggressive in the beginning if there's going to be a little bit more contribution coming from the National Pension Service? Is the increase in National Pension Service actually saying that what is required for individuals in the future is more? And so we should take that as a direction that we should be as aggressive or even more aggressive than we are. So these are considerations that we have around regulation. And then the participant behavior as well. I'll speak about some of the trends in the United States and compare them to Korea. So this is a small case study here of how we're looking at participant behavior, how they spend and save in the United States. Now, while the individual and the citizens and the workers in the United States are different than they are here in Korea, what we found is that it's, as one of the kind of most mature retirement markets in the world, the United States is a great place to start. It's a great place to understand the behavior, and then you can then take that as a kind of a information to help think through the local behaviors of any other country, like here in Korea. So we're using a database that's provided us called EBRI. It's a retirement database that provides us with 23.6 million different participants. So these are people who are retiring, to understand their data. What are they doing? How do they treat their retirement plans? We think about the saving phase in three different components. There's the early stage, there's the mid-age career, and then there's pre-retirement. And what we find in the United States is that there's contributions are happening in the beginning, and then in what's unique to the United States is that in the ages of 40 to 55, retirements are actually taking loans away from out of there. So they're basically borrowing from their retirement savings to buy houses, to take trips, to buy cars, big ticket spending items, and then they pay back that with interest. And then as of the retirement age, when you're getting to 55, 65, the trend of who actually starts to withdraw and when they withdraw is, how many assets do they withdraw? We find that they're generally, on an average, withdrawing around 55% of the assets. And then what happens when they do retire? How are they spending this? And what you find is that at the beginning, retirees are spending more of their assets, around 90% of their peak income. This is to go on trips, to visit their children, to maybe buy gifts for themselves. After 5, 6, 7 years of retirement, life slows down a little bit and they spend less. They're spending around 70% of their peak retirement. So understanding these types of trends helps us then go back and come up with the most appropriate asset allocation to ensure that when retirees are starting to borrow against their pensions, that we have enough stability within the glide path that they are not going to get hit if there's a period of volatility. Here, while they're still spending, we want to be generating income to ensure that they can live the life that they want and spend that percentage of their peak income, but also acknowledge that we don't need to be too aggressive in the income because their spending is going to come down after time. So this type of behavior is what we think about when we're designing the glide path, and then we have these same conversations with Hanwha, and we understand the Korean population's patterns and their trends, and that informs us to understand how to develop the target date funds here with Hanwha. And again, why is it that it's so important to consider these people, these individuals? It's because it's cash flow volatility. These behaviors can increase the amount of volatility that's coming into the overall target date fund. And when you mix that cash flow volatility with market volatility, you can have these consequences where you end up with inadequate retirement savings. And so we need to take into consideration how much additional volatility is being added to the glide path via these cash flow changes. Loans are not happening as much here in Korea. Individuals aren't taking loans as much as they are in the US, so we don't have to worry as much about that cash flow volatility to some degree. The US is not changing the amount of Social Security contributions that need to happen every year. Korea is, so that's a different consideration. So each country has their own unique aspects, but it's a great place to start to understand and to have all the support through these smart retirement funds and the large amount of size, the large brand, the massive amount of participant behavior we have to leverage that to deliver to Korean citizens and retirees a best-in-class target date fund solution. And so with that, I think I will wrap it up and hand over to the next speaker. And thank you very much for your time.